Hello, my dear fellow valuers. My name is Abhishek Singhal, and I am a property valuer and have recently passed my IBBI Land and Building valuation exam in December 21. I run this channel, IBBI Cracker, for the benefit of all IBBI valuation exam aspirants. The aim of this channel is to provide complete study material for IBBI valuer exam in simple and easy language, with mention of areas or key terms to be focused upon, because syllabus is very lengthy. We need to focus on certain areas, but we have to have overview of entire syllabus. So I'll cover 100% syllabus on this channel. Those who are new to this channel, I would highly recommend to start from first video, which is clear IBBI exam in 1 month, and follow other videos in chronological order if you really want to crack this exam in 1 month. Links of all related videos are given in description box, which is given below. So dear friends, let's get started. So today we will start our session. We are going to start a chapter, Valuation of Real Estate. This chapter carries a weightage of 10 marks in IBBI syllabus, and it is very important because it is going to be foundation for the entire IBBI valuation exam. So the syllabus is being divided into 5 sessions. So in first session, today's session, we are going to discuss about cost, meaning of cost, price and value, and comparison between these three terminologies. And then we will also discuss various type of values. There are multiple type of definitions which are being used in IBBI syllabus. For example, revisionary value, market value, right? So number of values are there. Value in use, value in exchange. So number of values are there. Reproduction value, reinstatement value. So there are number of terminologies which are being used in entire IBBI syllabus, and in numericals different types of values can be asked. So after that, there are other topics which we are going to cover into subsequent session, are like basic element of value, factors affecting value. So remaining topics we will discuss in subsequent sessions. So just for the sake of clarity, I have putting the remaining syllabus into these 2 slides, session 4 and 5. So we'll try to cover this entire 10 mark syllabus into upcoming 5 sessions. So first we have to understand what is the difference between cost, price and value, right? So cost, what is cost? Cost is like amount required to produce some goods or to acquire services. The keywords are to produce and to acquire. To produce some goods or to acquire certain services. It could either be expense which is already incurred, or estimated expense to be incurred. So it could be existing expense or future expense. Now what is price? Price is the amount asked by seller or offered by buyer or paid by buyer to seller for some goods or services. Price once paid becomes cost to the buyer. It is important aspect you should remember. Once a buyer pays the price, it becomes cost to the buyer for subsequent transactions. Now what is value? Value is usefulness of a good or service to a customer. It can be different, it can be same, right? It cannot be determined in money and varies from one customer to other customer, and varies from estimate of price what is ought to be. Let's have a deeper comparative analysis between these 2 terms. So how these 3 things can be ascertained. So in case of cost, cost can be calculated or ascertained from perspective of producer or seller. In case of price, it can be ascertained from customer's perspective. However, value can be ascertained from user perspective. So it is important aspect, and state question may come in IBBI exam, that cost is being ascertained from producer or seller perspective. Price is ascertained from customer's perspective who is buying, right? And value is ascertained from user perspective. Estimation, cost is estimated based on facts like cost of production. Price is being estimated basis the policy. and value is being calculated through the opinion. So valuer gives the opinion. Money, in terms of money, if we'll talk, cost and price both can be calculated in terms of money. They can be calculated, these two terms, cost and price, can be calculated in monetary terms. However, value cannot be calculated in terms of money. Impact of variation in market. Cost of input rise or fall. Cost of input can increase or decrease. Price of product can increase or decrease. Value remain unchanged. So let us talk about various types of values. These are the key terminologies which we should always be familiar with to be successful valuer and to crack the valuation exam. So this all these terminologies are very important, right? So I'm not going through these terminologies. So let us start with the first terminology, which is very common. It's called market value. Market value is nothing but estimated amount of exchange on the date of valuation between a willing buyer and a willing seller in arm's length transaction after proper marketing, wherein both parties act knowledgeably, prudently, and without compulsion. So the key words here are willing buyer, willing seller, arm's length transaction. There should be proper marketing and there should not be any compulsion on buyer or seller. Equitable value. It is the estimated exchange price between identified. So here the key word is identified. In case of previous slide, in case of market value, buyers and sellers were not identified, but here both are identified. Knowledgeable and willing parties. Both buyers and sellers are knowledgeable. They have knowledge of all the facts, right, about the property, and they are willing parties. There is no force on any of them to buy or sell the property, reflecting the respective interest of both the parties. Please note that above is the only erstwhile, is also the erstwhile definition of fair market value as per IVS 2013. Non-marketable value. It is the estimation of liquidation values. Liquidation value could be salvage value, scrap value, insurance value, right? These value may not be reasonably construed to represent the market value. So these are not market value. So we may, as a valuer, we may be required to calculate liquidation value, salvage value. So put together, these all type of valuations can be combinedly called as non-marketable value. Market rent. Market rent for which an interest in real property should be leased. Estimated rent for which an interest, it is the estimated rent for which an interest in real property should be leased on the date of valuation between a willing lessor and a willing lessee on appropriate lease terms in an arm's length transaction after proper marketing, wherein both parties act knowledgeably, prudently, and without compulsion. Right. So keywords are willing lessor, willing lessee, appropriate lease terms, arm's length transaction should be there. There should be proper marketing and there should not be any compulsion. It should be done without any compulsion. Investment value or investment worth. What is the value of an asset? It is the value of an asset to a particular owner for individual investment. The owner may be an existing owner or prospective owner. It may be different from market value. For example, a commercial builder may pay a higher cost for an agriculture land. What is value in use? It is the worth of a property to a specific user or a set of users. As value in use is related to specific user's need, it is also referred as subjective value. So this value is related to, it is the value of the property for a specific user or a set of users, not for entire market. Value in exchange. It is the price that would tend to prevail in a free, open, and comparative market on the basis of equilibrium between demand and supply. So price is determined by on the spot interaction of demand and supply. So what is the demand and supply of the property? What is the demand of similar type of properties and supply of the property, similar type of properties, that decide the actual value in exchange, and it may vary from time to time, morning it can be different, evening it can be different. So for example, if we just to understand value in use and value in exchange in terms of an example, let's take an example of bridge, road, flyover and other infrastructural assets are generally not exchanged. We cannot sell bridge or road or flyover, right? But there cannot be a value in exchange for these assets. So these assets have value in use, and their value depend on the benefits derived by the society out of these assets. This one more terminology, synergistic value. So if we have two piece of properties, two parcel of properties, two properties, and if combined value of these two properties is more than sum total of the individual property value, then the combined value is called synergistic value. Let us understand this concept with the help of an example. For example, we have a plot A with market value of say 100 rupees, and there is adjacent plot, adjoining plot B, which has value of 90 rupees. If we combine these two plots, if the value of combined plot, which is A plus B, is 200, then 200 rupees is the synergistic value. It is important because it may come 1 or 2 marks of question may come. The marriage value, it is the additional value that arise due to merger of two properties. So as we discussed in the previous example, so 200 was the synergistic value. So individually sum total of these two properties was 190 rupees. So because of merger or combination of the property A and B, the value of combined property increased from 190 to 200. So that additional value which has arrived because of merger of the properties, combination of the properties, is called marriage value. So here in this example, the marriage value is 200 rupees minus 190. So rupees 10 is the marriage value. Distress value, it is also a common terminology which we often encounter with in the market. If owner who is under legal compulsion, so keyword is legal compulsion, for immediate payment of legal dues want to sell his property. So the keywords are legal compulsion and for the payment of the legal dues. So but here always remember, here owner himself sells the property. So this is also a keyword of the distress value. One mark question can come. Liquidation values, when an asset or group of assets being sold on piecemeal basis, it should take into account the cost of getting the assets into sellable condition as well as those of disposal activity. It is of two types. Liquidation value can be two types. Number one, orderly liquidation value. Value of property that would fetch through auction sale in market after proper advertisement and publicity. This transaction normally happen in reasonable time after proper marketing. It is generally happen between unwilling seller and willing buyer. So this is important question, important point to be noted. This transaction happen between unwilling seller, please note down this, and willing buyer, right? And there should be reasonable time and proper marketing. Such auction may be under court order. So 1 mark question can come out of it, asking any keyword, whether it happened between the willing buyer, willing seller, unwilling buyer, unwilling seller. So this type of multiple combination can come in IBBI exam, and you can expect 1 mark question out of this point. So forced liquidation value, or it is also called forced sales value, right? Here seller informally, normally bank or court, receiver, etc., is forced to sell the property in compulsion without proper marketing, time and advertisement, right? So normally it is being sold within 30 days of time. So here the keywords are there is a force to sell the property, there is a compulsion, right? And there is no marketing, without proper marketing, time and advertisement. So these are the important terms which could come in the question also. So let us talk about going concern. Going concern value, right? It is the estimate of sum total of all assets, tangible, intangible, goodwill, patent, etc., less liabilities on the date of valuation of a business enterprise. So this terminology is more related with the valuation of companies, businesses, business entities, and it has less relevance from property valuation perspective. However, as a valuer, we should be familiar with this terminology. So rarely any question comes on this. A straightforward question can come of 1 mark on this point. Please note that business must be profit making and a running unit. At the time of valuation of going concern value, calculating the going concern value, the business must be profit making and a running unit. Both conditions must fulfill. Hope value. Sometimes owner expect some policy changes leading to rise in property prices in near future. This may happen, right? So keyword is policy changes. If some, for example, if some FSI norms are likely to change, and it is likely that FSI is going to increase in certain area. So with that hope, buyers may expect that FSI is going to increase. So people may start increasing the value of the plot or property land. Monopoly value. If one property has some unique advantage, so keyword is unique advantage, which other properties do not have, it may enjoy a higher price called monopoly value. If some unique advantage is there with the property, it may lead to a special price to that specific property. Potential value. Residential property in commercial zone may have higher potential value to commercial user. So if we have a residential plot in a commercial area, so though it cannot be officially, it cannot be used for commercial thing. However, since nearby commercial activities are allowed, so people who are specifically the commercial user, so they tend to prefer even that property, even if that property is not allowed for commercial activity. So as compared to nearby other residential properties, this residential property will fetch little bit higher price. It is called potential value. Sentimental value. If buyer or seller has an emotional or sentimental attachment to a property, he or she may quote higher price than the market price. For instance, a person born in a house, it is also called personal value. So if a person is being born is born in a particular house, so he may have some sentimental value. Like we have seen the picture Diwar. So Amitabh Bachchan's mother, was made in that house, in some house. So he wanted to buy that house because her mother worked in that house. So Amitabh Bachchan was having a sentimental value for that house. Just on a later note, there was a simple example. Speculative value. A speculator with or without reason may like to purchase a property even at a higher price with sole motive of selling it at a profit within a short period of time. So the key terminology here is sole motive of selling the property to earn profit in a short period of time. So the objective is that. It is a key word to be remembered. Special value. A buyer or a seller may quote higher price because of some personal characteristic reason, except emotional and sentimental. If the reason for higher value is other than emotional or sentimental reason, some other reason is there, so it is called special value. For example, if some property is there which is near to my workplace, so I may like to pay extra value for that property. Stigma value. It is the value of property considering unwilling buyer for the property, right? So here the keyword is that unwilling buyer. If people believe a house is, for example, if people believe a house is haunted by ghost, buyer may pay less because of stigma or disliking, right? Vista value. The open vista is nothing but the open unobstructed view in front of the building is called vista, right? The best example of vista is Rashtrapati Bhavan, which has a beautiful vista. So if you stand on roof of the house, what things you can see from there, what is the frontage, what are the things which are in front of the house. If you have a beautiful lake, beautiful ocean, sea view you have, river view you have, so it increases the value of the property. So next is mortgage value. If the property is being offered by a borrower to bank or lender and bank or lender may have its own margin requirement. So keyword is margin requirement. Then mortgage value is equal to market value less lender's margin. So let us understand this concept with the help of an example. Say bank lends against a property of say rupees 100 and keeps a margin of 40%. Then what is the mortgage value of the property? Mortgage value is rupees 100, which is value of the property, market value of the property, and rupees minus less rupees 40, which is the margin kept by the bank against the property while lending the loan. Next is statutory value. So statutory value is like value of a property estimated in accordance with provisions of the concerned statute. The best example is valuation under Wealth Tax Act. Right, so capital gain valuation we do. That's the best example of statutory valuation. There are certain provisions. We can also say under Land Acquisition Act, valuation and as per Land Acquisition Act is another example of this valuation. Salvage value, it is important terminology. There are two terms, salvage value and scrap value. So these two terminologies are being used interchangeably and very confusing terms, and question may come in exam asking difference between a definition of salvage value or scrap value. Right, 1 mark question may come. So in case a structure is divided into various components and sold separately as such, I repeat, in case a structure is divided into various small components and sold separately as such, then total market value of all such individual components is called salvage value. We'll explain with I'll try to explain this concept with the help of an example also. Let us understand. Let us go to the next definition of scrap value. It is also called junk value. If individual components have no use, thus have no market value, right, then such components are being sold at a cost of material from which they were made. Right, it is called scrap value or junk value. Let us try to understand these two concepts with the help of an example. If an individual shed is dismantled, for example, we have a steel truss shed and there are multiple steel trusses which are being used for construction of the shed. So if each of these steel truss can be sold without dismantling as such in truss form, so then the combined value of all such trusses is called salvage value. However, if these steel trusses are not marketable, nobody is ready to buy these steel trusses, so we have to maybe break those trusses, or without breaking the trusses we have to sell those trusses as per per kg weight to scrap dealer. So in that case, total value of the scrap metal used, iron or steel used to manufacture, which was used in manufacturing of these steel trusses, can be sold to a junk or scrap dealer. So that is called scrap value. Please be clear about this thing. Insurable value, it is very important. Numerical normally comes from this area. Insurable value of the property. It is the replacement cost or actual cash value of a building for which standard insurance policies provide indemnity cover. Right. So this is normally different from the market value of the property. Insurance value is normally less than the property's appraised value or market value, because it excludes certain things like land value and other certain items like foundation cost, underground piping cost, wiring cost, etc. So normally insurable value is less than the fair market value or appraised property's total value. So the exact formula for computing insurable value is usually stated in the valuation clause of the policy document. So the normal generally used formula for calculating the insurable value is that replacement cost, that replacement cost we will discuss in subsequent slides, less land value, less foundation value, then you have to deduct underground wiring and piping cost, and any other cost which is mentioned for exclusion in the insurance policy. This is how we generally calculate the insurable value of the property. And please note that thing, in case of insurance values, salvage value is normally considered to be nil until unless it is specifically mentioned. Certain salvage value is specifically mentioned in the insurance policy. What is intrinsic value? It is the inherent worth of an asset. Right, it is calculated using complex financial model rather than using currently trading market price of an asset. It is normally used for financial assets, so it is not very much relevant for the land and building valuation. However, for the sake of knowledge, we should understand the value. So basically, it is normally used for valuation of the shares, equities, bonds, for financial assets. Now, this is important terminology, reproduction cost. So these terminology, this term will be used throughout the course repeatedly, and multiple questions can come on these type of costs, which we are going to discuss in subsequent slides. First is reproduction cost. It is the cost of construction at a current price. So keyword is, please note that current prices of exact replica or mirror image. So mirror image, replica is also keyword. And using same material, exactly same material should be used, design, layout and quality of workmanship, and having same deficiencies and obsolescence. So it is the cost of reproducing the thing exactly replica with same material and same deficiencies, etc. So it is nothing but mirror image with same material and same utility. So please note down this thing in your notes, that reproduction cost is mirror image with same material and same utility. If depreciation is deducted from the reproduction cost, then it is called depreciated reproduction cost. The next key terminology is replacement cost. It is the cost of construction at current price of similar building having same utility and function using modern material, design and layout. So here key terms are current prices, similar building and modern material. So different material with same utility. So similar material we have used, right? So modern material we are using with same material, same utility. So in case of reproduction cost, it was the mirror image with same material and same utility, right? So here utility is same, but material is different. In earlier case, material was same, utility was same. Here material is different. It is also called replacement cost new, RCN, in short form RCN. Number of questions can come on this terminology. If depreciation is deducted from RCN, it is called depreciated replacement cost. Reinstatement value, it is synonymous to RCN, replacement cost new. So the next terminology is reinstatement cost. It is defined as the cost of repair of a building to reinstate it. That is the cost to restore the building to the previous state and at a same place. So the keywords are cost to restore and same place where it was before the loss. So the cost will exclude any cost of modification, cost of transfer to other place, the positive cost differential, or reinstating the property to another place. So any additional cost which is required to be incurred on the property is not considered. From insurance perspective, it is very important point, please note down. In case of insurable value and from insurance valuation perspective, when reinstatement clause is there in the policy, there will be no deduction for depreciation. Replacement value, though it is called value, actually it is an estimate of cost. So dear friends, that's all was for today's session. It was a lengthy session, right? I would request you to please note down the key points and have a review. And if you are not clear about anything, please review the video once again. And once you are clear about all the concepts in the existing video, then move to the next video. So before I'll tell you what we are going to have in next session, so I would request you all to please subscribe to this channel IBBI Cracker and click on the bell icon so that you will be notified immediately after I upload a new video PPT for the benefit of you all. So in next session we are going to discuss about 4 basic elements of valuation, which are marketability, utility, scarcity and transferability, and these 4 factors are combinedly called as STUD, right? So we'll discuss these 4 factors, how these 4 factors interact with each other, and how to arrive at valuation using these two factors. We will also discuss about factors which normally affect the property valuation. Right, so the next session is going to be a small session but very important session from exam perspective. So keep watching and keep preparing. Wish you all the best. Thank you very much. See you in next session. Thank you.